Good morning. This is Ken Long from Tortoise Capital Management with a review of the daily trading plan for next Monday, May 16th, 2011. We have a market that's in bullish normal conditions. On an annual basis, it's at 63 out of 100 using weekly RSI, so slightly above average. On a 10-day look back, we're at 25 out of 100 using the 10-day NDX, which is just a shade above oversold conditions. The percent stretch above the 200-day moving average at 9.19% is rated bullish, but it's in the white, so we've had much stronger stretches in the past 6 months. Slope of the 50-day moving average at 0.23% is positive. However, it's weak relative to the last 6 months, so it's coded red and noted as bearish. ADX 14 is almost purely sideways, with very weak or non-existent trending conditions at a score of 11.5. ATR percentage of 1.09% is right in the midpoint of the range of normal. Looking at the gap stat, in the last 30 days for symbol SPY, we've had 13 times the market has gapped down. 5 of those times it has reversed to close higher with an average return of 0.5%. 8 times out of 13 it has continued to fail further for an average failure of 0.30%. 17 times the market has gapped up in the last 30 days. 10 of those times it's reversed for an average fail of 0.41% additional. 7 out of 17 times the gap up has been followed by a continued move up at 0.36%. So right now the market has been reversing its gap exactly 50% of the time. 15 times the market is reversed, so we've got almost a pure definition of sideways market just based on gap and follow-through behavior. The range stat for SPY at 1.48% remains almost constant, and that's the average maximum normal move between low of the day and high of the day. On a time series for the 10-day NDX, you can see the market has pulled back and is just above oversold conditions. The overreaction system fires signals for EFA and EEM, and the channeling system is showing signals for EFA, EPP, and EEM. You can see the daily pivot, which hasn't really changed much in the last week due to the sideways nature of the market. You can see volatility has clustered right around the average here at just a shade above 1%. ADX has dropped off the bottom of the chart almost here, with even plus DI and minus DI failing together, the definition of a sideways market. In the 10-day max pain among the Dow, looking at commodity-based and financials with Caterpillar, ExxonMobil, Chevron, DuPont, and JP Morgan. So commodities and finances have been leading the way down. Among the ETFs, it's all commodities here, with silver, a couple oil ETFs, gold miners, and oil exploration. The leaders have become the laggards. In the short-term setups, we have a washout and a 551W in natural gas. The channeling system picks up a number of commodity-based with DBA Ags, DBC, the blended commodities, U.S. real estate, silver, emerging markets, and Asia, the Euro-Asia blend. Among the large caps, quite a few: Caterpillar, DuPont, Disney, GE, JP Morgan, Travelers, and ExxonMobil. Among the stealth candidates, we have the usual suspects: financials and technology. Technology has moved up to be one of the strongest sectors, so we've been tracking that for the last couple of weeks as it's made its stealth move and continues to be strong. Stealth candidates among the techs: Microsoft, Cisco, and Hewlett-Packard, with Procter & Gamble as a leading consumer staples and retailer. You can see the summary here on the daily Dow Tactical, quite a few dojis and channeling signals. The max pain range compression candidates, Cisco, which just had another sell-off and perhaps finding a local bottom, as it usually does this past couple years, climbs the wall of worry and then fails. ExxonMobil, Disney, Caterpillar, and Chevron round out the top 5 of max pain range compression. That's not a bad strategy to adopt in a sideways market, because you're looking for a one-day pop, and max pain range compression is something that is oversold and then found the minimum daily range on the previous trading day, so it may be acting as a coiled spring. Among the ETF 30 most liquids, I can see I've got that group now by channeling, quite a few signals there, only a few dojis. The max pain range compressions, silver, oil, mixed commodities, natural gas, and coal, all coming from the the commodity sectors. You can see right now the strength that have been in these defensive sectors, consumer staples, utilities, and healthcare. Over the past 10-day and 1-month look-back periods have really been standing out, whereas the former leaders like silver and oil have drifted back into the red. Silver, you can see with its one-day pop on Friday, remains an excellent intraday tactical target, but it's been so volatile that that there's not been an advantage to buy and hold. Looking at the additional charts in the mosaic, you can see the slope of the 30-day regression line is still positive, but the sideways activity very clear here. On a time series, the slope of that regression line has rolled over, crossed its own 10-day moving average, and are now drifting weaker. And you can see there's not much room in here between the 10-day moving average and the slope line when we zoom into the 30-day look back. But it's hovering right around average of the last 180 days. The percent stretch above the 200-day moving average remains locked in here at about half a standard deviation above average. And the sideways market is pretty evident here, as it's not been able to make headway, but the slightly bullish buying pressure has kept the percent stretch above average. Or this would be looking for a channeling type of plays here, as we're trying to make hay in between a plus 10 and a plus 15% stretch. Just for your reference, intraday range percentages, silver has backed off a little bit to just above 6.5%. It was as high as 7 last week. Holding X-day periods, this is just a reference table for you. What kind of historical performances have a representative set of ETFs had over various holding periods in their over the last 5 years. You can see a little bit of strength here in the mid caps and the small caps over the last 5 days. So those would be places I'd be looking for strength to begin emerging as we climb out of this almost oversold condition. Looking at the quality report for the Dow, I like to look for things that were horrible 2 months ago and then slowly improving, and that leads me to the bottom of the chart here. Hewlett Packard, Cisco, Microsoft, and Intel especially has gone from red to white, and the difference between that comes out at 4.67 system quality numbers, and you can see that the rebound effect when you look at an Intel chart. Among the ETFs, this analysis brings us towards Japan, and then the technology stealth move, and that the fact that it's just in the white right now over the last 30 days suggests that there's some real strength left available in the technology move, and so that's why I'm stalking the Qs and the four elements of the Dow that we really like to look at: Microsoft, Intel, Cisco, and Hewlett Packard. Those are all short-term trading targets for me. Looking at typical gap statistics, some reference tables here just for the big indexes, and then inside the safe zone analysis, you can see SPY has pretty much remained in this sideways channel lately. Daily pivots calculated for your reference. Stop the tape if you need to see them. Looking at the relative strength scores over the last 30 days, this applies that slope of the 30-day regression line, subtracts out SPY, and you can see just about everything hovering in the U.S. right around SPY, with a little bit of strength continuing here in MDY. That's the only one that's on the uptick lately, and so with the U.S. mid-caps being the strongest U.S. sector and the strongest sector in ETF2 for about the last 4 weeks, I would be looking for strength there. And that, if you're interested in the ETF, that's MDY, or you could be looking at the double leveraged with MVV. You can see that commodities have made starting to make a little bit of a comeback here, with oil and blended commodities coming back towards the baseline after an extreme move down. And then on the internationals, all suffering relative to the U.S. as money has there's been a flight to quality, in my view, looking at the U.S. defensive sectors, as we saw in the world market model. No trending action except for Japan got measurably weaker on Friday using the elder safe zone channeling concept. And just a quick review of the percent winner and losers over the last look-back periods. The fact that there are so much green and red in those tells you that extreme conditions produce extreme follow-throughs on both sides of the aisle, among the percent winners and percent losers. Correlation coefficients between the indexes for your reference. Japan continues to be the most uncorrelated compared to its peers when we look at the crosstab. And that concludes the daily trading plan for the Tortoise, and going into May 16th. Sideways market, lots of channeling. Intraday, shorter-term holding periods are indicated here. Emerging strength in U.S. mid-caps and technology is where I'm looking. To reward momentum in the defensive sectors looks warranted, and then if I'm looking for bounces, I'm still looking for intraday vigorous moves in the commodities, but not holding them overnight. So keep your powder dry, and we'll see you in the chat room and on the Objective.